Welcome traders. This will be the first video about our deep analysis of the book Secrets of a Pivot Boss by Franklin Ochoa Jr. I'll be going chapter wise to know the book in detail as I have gone through many videos and have known from the traders that this book was one of was considered as one of the best in the stock market field to learn the basics and a specific setup based on pivot is mentioned in this book, so we will go in detail. Let's start from the first chapter itself. The chapter 1 is about understanding the market, the auction process, the types of buyers and sellers, recycling market days, the types of market days, pursuing understanding. So let's start chapter 1. Is acknowledging about details. Fear and hope remains the same. Therefore, the study of the psychology of speculators remain as valuable as it ever was. This was one of the beautiful lines mentioned by Jesse Livermore. So, chapter 1. Chapter 1 is about understanding markets. The first line, which is again mentioned by Mr. Jesse Livermore, is nowhere does history indulge in repetition so often or so uniformly as in Wall Street. The Wall Street is the share market in USA. Here in India will be let's say it is NSE or BSE. It's basically a book based in the American share market. So we'll add our own inputs to this and we'll learn it in an Indian way. So the first thing he's saying is market itself repeats its old whatever happened in the old days. So we'll be learning from what happened before, like in the history. The first thing is understanding the market. I was able to pinpoint he is explaining about one of his experience. The opening lines are about his experience in the share market. Once he was able to find out a move in the market. I was able to pinpoint the explosive breakout that occurred on this day before the opening print was even recorded. So how he almost guessed or he almost was able to find out a breakout or the movement in the share market and he got advantage of it. So he is telling how did I do this? By having a keen understanding of market dynamics and pivot point concept. So these are the two things now we are going to learn about it. Market dynamics and the pivot point concept. Pivot point is a strategy used by the traders. So before an aspiring a trader can learn to make money in the game of share market, he or she must first obtain a proper understanding of the market. So here he is again focusing on us to learn about or understand about the market first. The role, the first process is to learn about the auction process. What is auction? The role, let's know what is, why we need a marketplace. What is the role of marketplace? It is to facilitate trade between a buyer and a seller. Obviously, a seller will be having a share of the company and he or she will be selling it to a buyer. And marketplace is the place where this auction process happens. So, how price continuously moves to higher or a lower price. The price continuously moves higher and lower in search of the best value to both buyers and sellers. Buyers think that the share which he or she is buying will move to a higher level, and the seller thinks that he or she already is done with the price of that share, and she doesn't need it. So they are selling it to a buyer. That's how the price is moving from one price to the other. Either it will be going higher or it will be going lower. The buyers will enter the market when they feel price is below the value, while the sellers will enter the market when they believe price is overvalued. It's pretty much simple here. Now there is two types of buyers. We have to know about how what types of buyers and sellers are there in the market. So as per Mr. Frank Ochoa, there is two types of buyers and two types of sellers. Which all are the two type of buyers? One is responsive buyer, and the second type is he is mentioning here as an initiative buyer. So what is a responsive buyer? A buyer that enters the market when price is below value is considered as a responsive buyer, and a responsive seller waits until price is above value before entering the markets with sell orders. Responsive buying and selling will typically drive price back towards the mean, sending price towards an area that is considerably fair value by the market. So the responsive buyers and responsive sellers, they will respond when there is a huge value for when there is a huge let's say when market is rallying to a higher price, the responsive buyer, the responsive seller will start selling his stocks off, like he already gained the percentage of profit he needs. So the price will come back to its mean. Mean means the average price. So likewise, when the price is dropping too much, the buyer will start buying, thinking that he is getting it at a discounted price. So the price will go back to the average price again. So these are the types of, when there is responsive buyer and responsive sellers, the market will be in a consolidation range. It will not be moving much higher or lower. Then comes the second type of buyer and seller there, that is the initiative buyers or the initiative sellers. In the initiative, buyers enter the market when price is set and above at or above value. This type of buyer is taking the initiative to push price to a higher value, higher area of value. So here these are the kind of buyers who appears when there is a breakout or something. When price has already done its consolidation, it has gone through a typical range, then a breakout happens, then the buyer thinks that the there is still more fuel in this share to take it to a higher level, so he will buy more stock that will ignite the price and it will go to a higher price value. That is the initiative buyer. Likewise, a seller, when there is a breakdown, when the when after a consolidation, if the share price is dropping, then the sellers will start continuously selling, and then it will take the push price to a lower area of value. An initiative seller is enters the market when the price is at or below value. This seller is taking the initiative to push price to a lower area of value. Initiative participants have greater conviction behind their behavior. So these are the two types of buyers and sellers. And the third is, and we'll move to the next topic, that is recycling market days. What he is telling here is every market day is unique. It is every market day is unique, but it is a clone of a prior day in history. Technical analysis works because trader psychology and human psychology for that matters never changes. So the way people think, the way people respond, the way traders respond to a price movement pretty much remains the same. The fear and greed remains the same throughout the year since the beginning of the, since as quoting him, it had been the same since the first exchange opened its doors. That means the human psychology and trader psychology remains same. So when there is a if a similar situation happened in the history, means this can happen even in the future. So by learning the old things, by knowing about what happened in this kind of situation in history, will help us to know what is coming, what is ahead of us. Trading is a game of repetition. Traders that can consistently trade the best repetitions are those that have mastered the markets. So if we can find what is repeating, then it will make it easier for us to guess or to expect what is coming, as this has happened in the history. If you are if you are disciplined enough to adhere to a proper trade management approach and play only the best setups time and again, you will become a successful trader. To become a successful trader, we must be disciplined and we must have a bread and butter setup. Here the bread and butter setup will be the pivot points, and the discipline will be to manage the money. It is about trading psychology, it is about risk management. If these three things, a proper setup, trading psychology and trading risk management, is if these three things are together, then there is a high probability that we'll become a successful trader. Many novice traders focus on the money too early in their trading career, which is a mistake as per him. So the focus should be to play the best setup at the right times while using prudent money management techniques. Money management, and these all are the main highlights of this book, is to find the best setup. Oh, oh, oh. At the right time using a prudent money management technique, and the money will come. The money will automatically come. We should not focus on the money. The proper preparation always plays a major role in successful trading. We have to prepare ourselves becoming before starting trading. Like, we have to prepare ourselves with the proper setup and proper money management. The first set is the first step in identifying your bread and butter setup is identifying the types of market. So the first thing is to identify the types of market. How many types of market days are there? As he already said that it is repeating. What has happened in the history is repeating again. So as per him, there are 6 types of market days. The first one is trend day, as we all know. So what I'll do is I'll add the charts here, so it will become more easier. So let's continue with the type of days. There are six. Uh, there are 6 types of market days, and the first one is trend day. The trend day is the most aggressive type of market day. It is the most aggressive market day. If it is a bullish trend day, the open usually marks the day's low. The opening will be the day's low, then it keeps on climbing like this. It will keep on climbing higher and higher. So here, let's find this is, and while the close will be the day's high, the closing will be the day's high type of day. And on a initiative, buying and selling is the culprit in this type of market days. Let's find a trend day. See here. So here the price opened. Where is it? Here the first candle is, here the first candle is this, then the first candle is broken, then it never came back, it just kept on rallying, it just kept on rallying, it just kept on rallying. This is a trend day. The opening was the lowest point, then the closing is the highest point. If I convert this into daily form, this is a trending day because here this opened the high of the day. It's a bearish trending day. Here this was the lowest, this was the low. Oh, I'm having problem with this, man. This was the low, and this was the high of the day, and this marked the low of the day. So it kept on falling the whole day. That is the first type. Let's go to the second one. Second one is pretty much like the second type of market day is called the double distribution trend day. This is also a trending day, but there is no confidence or conviction of a trend day. In trend days, the market will not take much time to fall or to climb. Like it will be a fast move. It will start from the day since it started. Let's say how much points it moved. It moved almost 3%, around 1500 points. The Bank Nifty moved on 28th of October. This is a trend day, pure trend day, because there is no time. The market is continuously falling. This is a trend day, but in a sideways, in a double distribution day, there won't be this much conviction or confidence in market to move. So let's find double distribution days here. There is no much conviction here. The market has moved only very less, but it is pretty much like a trend day only. It moved only 1%. There was an initial balance. Initially, there is an initial balance. So here we'll learn about the concept of initial balance. Okay. So the initial balance during this type of day, the market will usually open the session in a quiet manner, trading within a fair tight range for the first hour or two of the session, thereby creating an initial balance that is a narrow. The initial balance is traditionally defined as the price range of the first hour of the. Let's say this is I kept it as 1 hour candle, so this is the price range here. This is the price range here. So this is the hourly initial balance. So once this initial balance is broken, it started moving in one direction. So that is called initial balance break. So this is a double distribution. In the initial 1 hour, it just was falling inside this. Here also you can see this is the initial balance. So once this is broken, the day become a less trendy day. It's not, the conviction or the confidence is lesser. During this type of day, the open session is quiet, and then the initial balance is broken. If the trend here, he is giving an example also. If the trend day is akin to a sprinter, then the double distribution is more like a jogger. It is a slow process. See, here it is just moving back, it is falling, but in a slow way. So that is it. Then we will move to the third type. The third type is the typical day. The typical day is characterized by a wide initial balance that is established at the outset of the day. On this type of day, price rallies or drops sharply to begin the session and move far enough away from the value to entice responsive participants to enter the market. Responsive participants take the money to the mean. When there is discount, buyers will buy it and make it to an average price. When there is higher price, sellers will sell it and take it to an average price. That is the responsive buyers. So the responsive participants enter in a typical day. So there will be an initial wide balance. That means the buyers and sellers will not allow the market to move in one direction. They will take it back to the to the mean. So in the initial 1 hour there will be movement in both sides. Then there is an initial balance. For example, this is it. This is a typical day. There is an initial balance here. Then both the buyers and buyers, they kept on buying and selling. Initial, the responsive players push price back in the opposite direction. They just kept on pushing it back and front, essentially establishing the day's trading extremes. The market then trades quietly within the day's extreme that remains of the session. This is pretty much like a sideways market. This is a typical market, which is this is in other ways. This is a sideways market. Then the fourth type is expanded typical days. In the expanded typical days, this happened. Okay, here this is a perfect example for the expanded typical day. In this type of market is similar to the typical day in that it usually begins the session with an early directional conviction. There will be an early directional conviction. This is an hourly chart, so I am not showing the initial movements in this. Like it has gone up and down. That is why there is wicks here on both side, top and bottom side. Then it made a balance in the first hour. However, price movement at the movement at the open is not as strong as it's seen during a typical day. If it is in a typical day, the balance remains wide and the price remains to stay inside this balance itself, because but here in an expanded typical day, uh, if it is a normal typical day, the price will keep on by moving inside this wide range. But in an expanded typical day, what happens is the initial balance, while wider than that of a double distribution day, it is wider than the double distribution day, but it is not as wide as that of the typical day, which leaves it susceptible to a violation later in the session. Eventually, one of the day's extreme is violated, and the price movement is seen in the direction of the break. So here, an initial balance is made, but it is not as wide as this trading range day or a double distribution day. It is bigger than a double distribution day, but not as big as the typical day. Sorry, not about trading ranges. That is the next type. So here it has made a initial balance, but with time it got weaker. It is not wide as typical day, but it is bigger than the double distribution ray. So at the end, one of the day's extreme is violated. Here the lower end is violated and then price moved lower. This initial balance is broken. So this is called an expanded typical day. It can happen here also. If it is moving, it can, if this balance is broken, it will move higher also. So that is the expanded typical day. Now let's go to the next just clean this off. So let's check the last two. Now we have completed uh, four types of days. One is the trendy day. We'll go in detail about this. This is now the fifth and sixth one. The last two types of days. The one is trading range day, and the other last one is sideways day. So the trading range day occurs when both buyers and sellers, these are basically the sideways days. This occurs when buyers and sellers actively auctioning price back and forth within the day's range. Price is moving in between the days range. There is the price is being pulled from a low. Like here we have an example. It has pulled from here to the high. Then the initiative sellers started selling from here, and it just got back here. Then the buyers is trying to push it back, then the sellers again took it down. So it is pretty much a sideways market. It's moving like this. It is pretty much like a sideways market. It is moving in a sideways, but both the sellers and buyers are moving the price. It is, we can say the expanded typically a trading range day, a trading range day as a game of tennis. Both the players stand on opposite side of the court and take turns volleying the ball to one another. So it will just keep on like a tennis match. It will be going from this to this and from this to here, then here. So the buyers and sellers are just keeping it up and down. That is the trading range. It is playing inside a range. Now the last type, that is sideways market. Sideways market happens on mostly where both are not. However, during a sideways market, however, there is no volleying or probable tennis ball between buyers and sellers. Probable, there is no tennis ball. There is no ball between. That means the price is not even moving there. It is pretty much a stagnant day, like on a holiday, or if there is some big events as economic reports or news events is happening, or a day in prior to the trading holiday, this kind of situations will happen. Mostly there won't be any buyers or sellers on sideways. Do I have an example here for a sideways market? Here this is the sideways market. Pretty much the price is stagnant here. It opened at a price and closed at similar price. It opened it here. It opened here at this price and pretty much closed at the same price. There was no, even though it just rallied, it is stayed sideways throughout. That means there is less participants. So these all are the uh, 6 types of market days. Every trading day should be a trading day. He's telling that we should choose only the best trading days, like on a trending day, to avoid if you are option buyer, or if you are trading, if you are a trend trader, we should avoid the sideways markets. We should choose the best trading days to trade. It should not be like that we should be trading every days. You should only trade when the circumstances are the most favorable. We should find the ways that when the probability is very high, it's a game of probability. there is 50-50 chance or 60-40 chance based on your setup to get profit. So the trade should be initiated only on days when you think that it is the most favorable day. The trader should always reserve the right to stand on the sidelines if the trading day is not perfect for you. If you feel that it is not the day to trade, then you should have you should reserve the right to stand on the sidelines. Those traders that can learn to sit on the hands will profit by not losing. This is something that cannot be overstated. The difference between profitable traders and losing traders can usually be summed upon by the number of unprofitable days and the severity of unprofitable on those days. Learn to eliminate those unprofitable days by only trading in the most favorable market conditions. This is clearly saying that we should cut the losses. If you feel that this day is not, our setup is not going to work on this day, then avoid the trade on that day. It's as simple as that. While every market day is similar to a day from the past, similar does not mean exactly. So you can't expect the next move will be, you can't say that the next move will be like this. But it is similar to a thing happen. It is a game of probability. Instead of simply learning a new concept or idea, make it a habit to understand why a concept or idea works. So practice or check what all the days are happening these 6 days as I have shown in the chart, the 6 types of market days. You can also check one by one which all are the days that is happening. I have marked it here. It's in the 15-minute chart, it will be visible. These all are the 6 types of market days. You can check even on the next days. This will help to know what is the day like. On a trending day, normally the market moves very quickly because it has to travel a very long distance. So on a trending day, the initial movement itself will show that it is very huge. The day is going to be a trending day. It is falling in one side. It will be a one-sided market. The opening will be the lowest and the closing will be the highest, even though there is something happened in the end here, which is gain. And the second day is double distribution day. There will be an initial balance, then there will be consolidation, and then again a distribution will happen. It is not a typical trending day. It doesn't have the confidence as such in the trending day. Then the third type is the typical day, which will be having a very wide margin, wide initial balance. The initial balance is the first hour, high and low, and the trade will be happening inside that day because uh, the traders will try to push the market in both sides, and it will not be that much. There will be less movements on that days in the afternoon session. Then the expanded typical day is, it will be having an initial balance. Initial balance is the first hour balance, first hour high and low. The width of this initial balance will be more than the double distribution day and less than the typical day. So what happens is, after this consolidation, there is a high chance that it will break on high or top, either on one side here or here. There is a huge chance that the price will break after a consolidation. The initial balance will be broken and then we can take a trade on that side. It will give a one side move after that. This is the fourth type. This is the first type, the trending day. Trending day is the first type. Second type is double distribution day. Third type is the typical day. Fourth type is the expanded typical day. Fifth type is the typical range day, where market moves inside a specific range. It will be moving, the initiative buyers will be sellers will be taking it to one side. It is like a tennis ball match. Then it will be pushed back to the high. This is the fifth one. And the sixth is a typical sixth day is a sideways market where nothing happens much. It will be pretty much where the opening price and the closing price will be pretty much similar. It will be mostly on holidays. The price won't be moving. There will be very less participants in this. So these are all the main concepts in the first lesson. This There will be initiative buyers and initiative sellers, as well as responsive sellers and buyers, and then the 6 types of market days. So thank you. Then we will next meet for the next chapter in the Pivot Boss book. This will be continued in the second video. Hope you all like the video. Thank you so much.